Hello, everyone. This is Liam Davis from eToro, Popular Investor. I just wanted to make a video update this time. I want to go into a bit more depth on a particular topic than a text post that I usually make would go into. So yeah, I'll be talking about that fairly major in terms of economic direction, and I intend to point my account trading in the same direction as I think as the markets are going. So I'll explain more, but first I just want to say a big thank you to everyone. Really, my account on eToro is approaching its 10-year anniversary, so that'll be in September 23, which is really amazing. Like, I never thought this kind of thing would happen, but I've been a popular investor since I think 2016. So that's the majority of my time on eToro has been as a popular investor, and it's been really great. And I now looking to the next 5-10 years to keep growing. And yeah, once again, thank you to everyone. So the topic that I'm sort of discussing today is to do with that. What is the direction for the next 5-10 years? And I'll go over to this chart and we can look. I'll explain everything about what this is. So we're looking at this, which is a kind of a complex chart. I'll just take the drawings off for a second. So what we're looking at is here the US Treasury 10-year bonds, but minus the 2-year bonds. So this is long-term bonds, short-term bonds, and the difference in price, in yield between the two. So you can see these areas in red below the 0% line. This is when the short-term bonds, the 2 years, are offering a higher return rate than the long-term bonds, the 10-year bonds in the green. So what does this mean? So realistically, this means economic downturn, recession in real terms. We've seen this repeated time and time again, but it basically means that governments are offering more money to investors than for their short-term bonds than for the long-term bonds. Why do people want more short-term bonds? Because there's uncertainty in the market. People aren't willing to lock up their money for 10 years at the moment. They want their cash more readily available. They will take a short-term bond, locking of their money, but not 10 years. So like I said, we've seen this happen in the early 90s, in the early 2000s, late 2007, 2008, 2019, going into 21. I'm sure you can guess, what each of these points are. This is, the recession in the early 90s. This is the dot-com bubble, the subprime mortgage crisis, COVID, and war in Ukraine coming shortly after. So this sort of indicator has been fairly reliable in picking out recessions over the years. So we're looking here to today's date to see that the inversion has gone further beyond anything that's been before, down to a 0.7% difference, which is massive. What that means in terms of severity of recession, I'm not entirely sure. Yeah, at a guess, I'd say that it might be more prolonged, more severe than we've seen in the past. But who knows really? but we can look to trade into this, to invest into this in particular ways. And we can look at, two different areas to be investing in: companies that are what you might call recession proof, not proof, but perform better in times of recession. So we're looking at utilities. That kind of goes with energies. They've already been doing very well. Utility companies, healthcare companies, consumer defensive. This is a bit more of a technical term, but it's companies like you can Google search consumer defensive companies, but a few examples: Target, Walmart, Coca-Cola, Pepsi, some tobacco companies. They all fit in this category. Energies, like I've said, materials. This is the inflation proof in inverted commas. Again, not proof, but perform better against inflation. We're looking at energies, materials, particularly gold, precious metals. These gold's been performing really well over the last couple of months in the face of everything that's been going on. We're looking to pick up value stocks, and then consumer staples, very similar to defensive. Things that people need more than luxury items. And then we may look to avoid or take short positions in these areas. So tech companies, which is makes up a lot of the S&P 500, and then all these next four, you'd kind of put under the luxury item category. Cars. I wrote a post about this a couple of months ago about BMW. A trade in that particular market. So cars, airlines, hotels, and high price retail, all luxury items. People are going to be spending less money in these places. You'd expect these kind of companies to be doing less well during a recession. This kind of strategy is what I'm going to be looking at over the next probably 5 years plus, assuming that this is happening, which I'm pretty sure of. So this is kind of what you can expect over the next few years. We can see these events happen, on the S&P 500 chart. This correlates with the dot-com bubble. This is subprime mortgage. This is COVID. This is the war in Ukraine. These things have a big effect on the markets, and traditional kind of tech stocks in the S&P don't do particularly well, unfortunately. I'll just go over the gold chart quickly because I mentioned that. See, these last 2 months we've done really, really well on gold. I've been in gold for a long time. I'll look to add more probably. But yeah, this is not some kind of short term trade. This is looking at a long term strategy for the next number of years. So yeah, with that, I hope this is giving you some good information as to how we're going to be looking to perform. And I hope you all have a great new year, and I will see you all in 2023. Thank you very much. Bye bye.